Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going out there? It's June 14th. I'm Frank Curzio, it's the Wall Street Unplugged. So we break down how it's end. Tell you what's really moving these markets. We just finished watching Narcos, the series on Netflix. It's been out for a while. It's Pablo Escobar and the Cali cartel taking over. I never realized how much power these guys had. I didn't realize they were billionaires. They were actually billionaires. They were among the richest people in the world. Pablo Escobar tried to get into the government. He wanted to be president. It was insane, some of this stuff. These guys are paying off entire governments, the entire police force, most of them. The utility companies, this way they could tap anyone's phone. They knew when the DEA was listening. When they came in, they had people just watching the airports and stuff like that. It's amazing. No matter how many guys you arrest, you'll never, ever be able to stop the trend. Americans love cocaine, and they're going to continue to buy it no matter what, and they're going to find ways to get it into the country. So I was so surprised all the stories of fentanyl that got so out of control, right? So dangerous. I heard you just open it and you could sniff it and you could die from it. But if you got fentanyl, that really hurts the cocaine industry. It's like tighter restrictions across borders. You have politicians talking about it. Crazy, and Mexico border coming in and all this stuff. You think the cocaine cartels would have killed the fentanyl cartel tribes and would have wrecked them. Anyway. Stuff is fascinating to me. You can really learn about running a business by watching that show. How organized they are. How they scale the business. I don't know if you saw the movie Blow. He was in jail and said, oh, you have the wrong dream. Selling marijuana and has planes. He's like, no, you got to get into cocaine. Went from selling it in Colombia, South America, into Miami. That was in Miami for a while before they were like, let's try to get to New York. And then all the way to L.A. We teach you how to eliminate your competitors. Not in the right way. But man, what an awesome show. It really details the government, DEA, going after people, entertaining its tales. 3 seasons. I saw the first season a while ago, Pablo Escobar, season and a half. Then with the Cali cartel, I just finished that one. It was amazing. Amazing stuff. So definitely recommend. If you got some time, and if you're an entrepreneur, definitely watch that. You can have some lessons from one of them. Building a business from scratch. Pretty crazy. Anyway. Let's get to the markets. I guess risk is back. Tesla up 13 straight days? Tesla? Aren't they cutting prices and margins getting crushed? Doesn't matter. See SoFi, remember that bank? Surging 12% on Monday. Carnival, upgrade, pops 12%. Long Norwegian Cruise Lines that pops 7%, which is the name in our Curzio Venture Opportunities portfolio. We're now up over 40% on that name. Remember Palantir, and everybody hated that stock. I mention it on Wall Street Unplugged Premium Podcasts, host every Thursday. It's trading at $7 a month ago. It's over 15. You guys take a look at the VIX, the fear index. Under 15. I mean, levels not seen since pre-COVID. Would you say that there's less risk right now compared to any other time? The Russell 2000 was up 7 sessions in a row. Down a little bit on the 8 sessions, still up 7% in 8 trading days. 7%. The Russell 2000, we're talking about a stock, the whole index. And this is happening in the middle of interest rates. What do you think they would be doing? The fear index is down right. No, they're surging, absolutely surging. 10 years at 3.7%, highest level since when we hit the banking crisis, and then before that, 2022 crash. In October, not a good sign when that's happening. The 2 years, 4.6%. 1 year treasuries over 5%. Remember when interest rates, when they were going high, it was bad for tech stocks? Bad for risk? Remember that? Forget about that. Doesn't exist anymore. It doesn't matter. Nobody cares. What about sell them A and go away? Remember that? So in May, the NASDAQ outperformed the Dow by 10%. By 10% in 1 month. That only happened 8 other months. 8 times in the history of the NASDAQ since the 1970s. Only 8 other months. So forget about that. Sell in May and go away? No. This is happening while tech earnings last quarter, believe it or not, some people don't realize this, they're down 5% year over year. That's up 25%. Yet their earnings, and you wouldn't think that from watching, because all you hear is they beat. You didn't know that they lowered considerably going into that quarter, which is fine. It's my job to tell you that. But it didn't matter. It doesn't matter. Nobody cares. P's don't matter anymore. You look at tech stocks right now, trading over 40 times earnings. 40 times. I mean, take out COVID with the nonsense with the 2 years where, we're shutting down 90%, 100% of our revenue stream, which never happens because of lockdowns, and then we're injecting $11.5 trillion into the market, which, again, I always use this analogy, but to save the entire planet in a financial crisis, it cost $460 billion. Seemed like a lot of money at the time. Remember, everyone's going, oh, my God, $11.5 trillion we spent in 2 years. $11.5 trillion. Trillion. So if you take out that, nonsense of 24 months, 40 times, right? Last time the NASDAQ traded at these levels was 2002, 2003. I mean, are you kidding? 40 times? This is all happening while New York vacancies sit at a record 22.7%. 22.7% vacancies. This is their commercial real estate. Now, experts predict that it won't go lower than 19% before at least 2026. So I hate throwing numbers at you without putting perspective behind it. So vacancies for decades and decades and decades in New York City at its worst case and never averaged more than 11%. We're at 22.7%. And again, the leading people in this industry who follow this industry for decades say it's not going to go lower than 19%. For another 4 years? 3.5 years? We're seeing this move in stocks and to risk with credit tightening to levels. And you know what? I'm going to pull this up for you guys because I'm going to make you watch my YouTube channel. It'll be worth it for these 2 charts. Trust me. You should know these charts. So there's 2 lines here. One is credit conditions by the NFIB. So this is current and expected. And then they have the FSLO credit conditions, which is a darker line. So this is tightening standards for loans to small firms. So if you look, it's like a standard deviation chart. So it's like 0, -1, -2, -3, and then 1, 2, 3, 4. So 0 is the line where that's where it's supposed to be traded. Now, there's only 3 times in history that we've seen credit tighten to this extent. And by the way, we're probably in the 3rd inning of credit tightening. In the 3rd inning. We're not even close. Every month that goes by with interest rates high. The Fed's not going to lower anytime soon, right? We know that. They can't lower anytime soon. Not where the core is. Only 3 other times. You want to guess those times that we were down to these levels where credit tightened this much? Okay, this is on the -3, okay, which is bad. That's steep. Okay, meaning that conditions tight. When did this happen? 2000. What happened? Crash. 2008. 2009. Crash. And we have a blip in 2020. Again, forget about the 2020 COVID ups and downs, right? And then right now, currently, we're sitting at below levels pretty much in line with levels from the 2000 crisis. And again, we're in the 3rd inning of this. So tightening credit conditions where higher interest rates, again, constant drag. Home price values are going to continue to come down little by little. It's like rental incomes are giving up a little bit, and you've seen inflation numbers start to come down a little bit with oil and things like that. But if you're looking at household wealth, is going to continue to go lower and lower and lower and lower at high interest rates. That's what it does. It's not a one-time. It's not a one-off. It's not a write-down, a write-off. It's not a one-time thing. As long as rates remain high, these conditions are going to be tighter. It's less credit to the overall market. Profits and margins are going to be shrinking. That's what you're going to see. But when you look at this chart, it's pretty scary. Now, I have one more for you. Because now with the Fed, they're like, well, they're going to pause. And then they're going to lower. They're excited about. That's a great thing, right? Please check out the YouTube channel. It's for free. I'm not pitching shit to you. Look at this chart that I have up, Fed funds target. If you look, there's 3 times since 1998, or even go back to 1998, where when you look where the Fed stopped tightening, okay? What do you think those 3 levels are? 6/28/2000. When did the market start to crash? Okay, so we have these rates, hikes, a pause for a little bit, and then we see them start lowering. Now, as they're lowering, the market is crashing. Now, why would you think that? Because the only way you lower rates is if the economy is horrible. Which right now, it's not really that horrible. It's supposed to be in a recession, but it's not. It's growing like 1%, 0.5% now in next quarter. But it's really weak. So 6/28/2000, right? When the market crashed. March, for 3 years, 75% decline. Then what was the next period? Well, if you look at 2006, August 2006, right when the shit started hitting the fan, that's when they paused. That's when we saw what? We saw subprime names countrywide. Early 2007 started to go on. In 2007, we saw the cracks. And you look at even 2008 when Bear Stearns went under or almost went bankrupt and they got bought for whatever it was, $2. After that happened, the market went up considerably. I think it went up over 20% over the next couple months. And then what happened? Everyone said, it's done. It's done. We're good. You have nothing to worry about anymore. We're fine. Just like we said with the recent banking crisis a couple months ago. We're fine. We're good. We're past it. You really think we're past it? Where interest rates are right now, you really think we're past it? Commercial real estate? Who's buying commercial real estate right now? You out of your mind? Nobody. See delinquencies for Capital One? See some of these numbers out there? You're having trouble paying their bills? So the second time, I still have this up, Fed funds start, when they paused, before they started lowering, again, they had a little bit of a pause. It was in August 2006. What happened? They paused, and then they started lowering, I think starting either late 2007, and what happened? As they lowered, the market absolutely got annihilated. And then we have right now, where rates have gone up more. Right? If we look at the period in 2000, leading up to that, rates were about 4.5, and they went to 6.5. If you look at the 2005-2006 period, as we were raising rates, we went from 1% to about 5%. We went from basically 0.25 to over 5%. And it's much, much quicker than we did last time. So for those of you thinking like, hey, a pause is great, it's usually a sign that's a top. So in other words, maybe you should hope that the Fed doesn't pause. And if you're a bull, maybe wish otherwise. Because if they pause just before they start lowering rates, it's a sign to get the hell out. Go. Run. Clear chart. Again, check it out, guys. Fed funds target, 1994 to 2023. And this is when they left rates unchanged after at least 3 straight meetings of rate hikes. Those are the 3 periods. It's not like skewed where there's a period here. No, if you look, it's clear as day. Which is kind of crazy. And unfortunately, if you go to YouTube, you guys see my beautiful face with my 2-collared shirt. That all my New York friends make fun of me when they see this. So you're looking at this, and a lot of this stuff is happening in the middle of a lot of risk out there. But we're so consumed with bull market, bear market, recession, no recession, crash, melt up. Yes, no, black, white. That's the new world. That's the new world. With like a minute interval before things change, for bullish and bearish and bullish and bearish. I mean, I watch Kramer. I mean, he seems like the biggest bear in the world, and 2 days later, he's the biggest bull in the world. Like, it's just back and forth based on this crazy news flow. But I think we have to start looking at the markets in a different way. This includes myself. If you look at the markets, and I'll give you a good example, if we pull back and we go into recession, usually risky stocks, small caps, get crushed. That's normal. Risk off. Usually happens in a higher interest rate environment. Credit tightening, right? Get the hell out of risky stuff. Risky stuff's doing well all of a sudden. Tesla up, 12, 13 straight days. Holy shit. Again, in the middle of lowering prices, lowering margins. Doesn't matter. And over that time frame, I think it's up like 35%. Crazy. But if you're looking at small caps, these risky stocks, they significantly underperform the NASDAQ year to date. And what does that mean? It means that a lot of the risk is priced into these names. So even if you're anticipating a market pullback, it doesn't mean small caps are automatically going to get nailed. In fact, the reason why they're starting to surge are up 7%. The Russell, mentioned earlier, in the past week or so. So another good example is Macy's. Macy's came out June 1st, and this is from the January period. So in March, they said, look, the consumer's really cutting back. It's cutting back. It's cutting back. They're cutting back. Holy cow, they're cutting back. And they said that we're adjusting our earnings a little bit lower for the end of the year. Okay, this is in March. June 1st, they report, they're like, we were wrong. The consumer's cutting back much, much more. They missed earnings and lowered guidance significantly. So in June 1st, the stock was like a $14.50, $14.75, and it fell to 13 and change, 13.20, 13.30, whatever. It was down 13% after they reported after hours. It finished the day down 2%. You know what Macy's is now? This is June 1st. We're talking about 12 days, 13 days ago. Macy's is trading at $16. Why is that? Because Macy's was down heading into that quarter from $25 a share. It was down 50% from its highs before reporting. It wasn't like up consistently into the quarter and then reported these numbers. That's what you see at Dollar General. That's what you see at some of these stocks, these retailers that got smoked. Like a 10-day span where you saw stocks falling 15, 20% after reporting because they were up going into the quarter. Macy's gotten crushed. So it's down from 25 to 14.50, then it goes to 13. It's trading at 6 times forward earnings. Even though they lowered those numbers considerably, a lot of downsides priced in. And Macy's is not a one-off. I cover small caps all my life. It's what I've done my entire career. From the start, small caps. Stocks under 10, Jim Cramer. Single-digit stocks, Stansberry, starting news like that. Now, Curzio Venture Opportunities, I read. This is what I love to do because you cover companies from the very early stage. Sometimes it's my models, right? I'm the only person covering some of these names. I love this area of the market. Some of them. Some of the Russell 2000 stocks have 15 analysts covering. Sometimes they're bigger. But I'm seeing the same case for a lot of small caps where these companies have gotten annihilated. Biotech names trading their net cash about a month ago. I mean, they've been surging. Why? Because they already got annihilated. And when you see one sector of the market surging, especially getting super expensive, I told you the 13Fs, which recently came out, those are all the biggest firms that have to report their whole. I've never seen, I can't remember. So we're talking about 10, 15 years at least, that much money go into the top companies, like 6 or 7 of them. Almost every single fund. Usually some of them have like 10 different holdings, maybe 3 holdings, maybe 3 new holdings. I mean, every one of them, NVIDIA, Google, Microsoft, Apple, pouring into those names. Pouring into those names. Which means what? They're over-owned. And what are they going to do as they get a little bit more expensive? Well, they're going to diversify. What are they going to diversify into? Some of the names that haven't really performed. And that's the pool of money going around. In order for the market to actually crash, you're going to have to see the companies with the highest market caps, those 10 that account for 30% of the S&P 500 now, 31% to be exact, the 10 largest companies. We haven't seen that high of a concentration in market weighting since 2000. It's 2000 and now. We know what happened last time. But again, for those companies to come down, their balance sheets are very, very strong. Maybe they don't fall that much. If they don't, you're not going to see the overall market crash. So you don't have this crash call or recession call. And, you know, when they announce a recession, it's usually happens 6 months before they make the announcement, and stocks usually fall before that. And stocks never bottom before a recession. Never. And we're heading for a recession. I think most people believe that. I mean, based on GDP, maybe it might take an extra quarter. It's saying something since we're about 22, 23% off our highs now. But you have this sector that's so over-owned that now you see money pour into other areas. Maybe that's why the small caps, Russell 2000 is up. tremendously. When you look at it as a whole, Curzio Venture Opportunities, and I mentioned this earlier, if you're ever thinking of subscribing to that that's a flagship product. Again, that's what I've been doing my whole entire career with small caps. This newsletter also offers private placement opportunities. But if you're thinking about it, now is the time. The ideas I'm seeing in this space are incredible. You see it within the portfolio. A lot of these guys have good management teams, have been pricing in a recession, lowered costs significantly, yet their stocks still got annihilated. Not like many of the large caps. If you listen to this podcast for the first time, you haven't heard me pitch that newsletter outside for the last week or two. For a year. Because I like to talk about products when it's a good time to come in. Because if you come in at the wrong time and you get wrecked, what are you going to do? We don't get paid by any company to recommend them. We have people that pay us as subscribers and we have to show you performance. If we don't show you performance, you cancel and you leave us and I can't feed my family. It's that simple. And that's the way it should be, right? It sucks it's not like that in sports. Guys sign $300 million contracts like, man, Scherzer and the whole Mets squad, right? Jeez, Verlander. Oh, man, it's terrible. Terrible. It's insane. Then what happens? You get hurt. They got insurance on it, but still. Love baseball. Man, I wish I was a left-hand pitcher. I mean, just get me. I could walk a guy and get paid $1 million. You don't have to pay those guys like $10 million to walk batters. They come in for like 1 or 2 batters. I'll walk a guy and give up a hit, and they sit down. $7 million a year because they're lefties. I need to be a lefty. Anyway. When it comes to small caps, usually charge anywhere from $3,000 to $5,000 for an annual subscription to this product. And maybe biased here, but it really is worth every penny because of the research that you have to do. And when you're analyzing small cap stocks, large caps are easy. You get research every place. You can pull up Google. You know the numbers are everywhere. Small caps, again, when I'm doing the model, a lot of people look at my model. So I got to, make sure it's accurate as possible. So that means visiting management teams and traveling, going through the numbers, going through the story. I mean, it's a lot of work for that product. And I love it. I love that part of the business. It's great. Became very wealthy focusing on this area of the market. But starting next week, I'm going to cut the price of this newsletter by 75%, one time only, for Curzio listeners. That price is probably going to be around $1,000 for the entire year. That will never happen again. It's not going to happen next year. If you subscribed already, you could add this on. The reason why, because I know if you subscribe to this product, you're going to be a client for mine for at least a decade. That's how positive I am. And if not after a year and doesn't do well, then okay, you don't ante up. That's fine. Well, I haven't had many private placements in this newsletter, probably for the past 18 months. I travel, I speak at mining conferences in Vancouver and, really tied into that industry. But the last 3 years, I haven't really gotten to, I avoided a lot of these stocks and private placements for at least the past 18 months. Rightly so, because we would have got killed on a lot of mining stocks. Even SPAC deals. It was SPAC deals that came my way, and I hated SPAC deals because of the amount that was coming out at under $1, under $2. And sometimes you really had to ask questions because they didn't have to report like their warrants and their structure. What a structure, SPACs. What a structure to completely fuck the regular investor. Oh my God. And they let you do it too. The regulators, SEC, there's a bunch of assholes going after crypto. I mean, they didn't even care. You don't even know the pipe deals that happen behind the scenes. They don't list anything. I mean, they just created so the insiders can get out much, much quicker than having to wait 7 to 10 years for liquidity period of investing in a private company. Now you got all these pipe deals. These guys are getting free stock. They don't care if it goes from 10 to 6. They're still making a fortune because they own it at $1. They're blowing out of it, killing you. And you're like, what's going on? How come this company's down so much? How come they got crushed? Because it came out at $3 billion valuation and it's trading at 900 times sales. That's why. It's not even that it's a bad company. It's like you're paying $25 for a Snickers bar. It's a good candy bar. You're not going to pay $25 for it. You're like, I'll wait till it comes down. It goes to 20. And you're like, all right, I'll buy it. Then it goes to 15, 10, 5. How's it still going down? Who's selling? All the people that got into that deal 4 months ago, that's who's selling. And much less disclosure. You don't have to disclose warrants or anything. It's so funny how the biggest guys, like the Ackmans and all these other freaking rich idiots, all got in late, right? They were like, oh, now we're going to launch our special fund. I mean, man, money. I mean, it's the death of everything. It really is. And that's coming from someone who's Wall Street background. It's just the greed, right? The billionaires and the greed that comes from it. It's like, oh my God. And it all comes at your expense. It only works if the retail investor buys in. It's like, who's the suckers that we could sell all this shit to? Who do we have to lie to? Who can we lie and tell everyone this is the greatest? They will all go into space like Chapman did. We're all going to space. We're all going to hang out. Yes, thumbs up across from the New York Stock Exchange with a big thing plastered there. We're all going to space. That company's done. They cashed out for $150 million. So Chapman sold. Totally out of position. Probably sold that thing at like 20-something. Man, if I had to guess, probably $3 now. It's going to be zero. We're going to space. Everybody's going to space. Everybody. It's great. It's so great. You can't make this shit up. But it's insane. Yeah, so I love covering small caps to tell you who's bullshit and who's not. What structures are good? Inside ownership. What's the management team's growth? What's their goals? Why is the stock down? Are they addressing, which is fine. Small caps have ups and downs, ups and downs, ups and downs. It's okay to have the downs if you learn from them. Have they learned everything? Do those problems still exist? Have they taken care of it? Because the stock went from 20 to 10 or to 8 based on these 3 risks, and those risks no longer exist anymore. Meaning this thing, they know what they need to do to get back up to $20 a share. There's funds coming into this thing. Funds that have great performance track records. A lot of guys you never even heard of. Getting $100 million. If you manage more than $100 million, you got to report this stuff. They become a significant owner. It's new positions. That's what I love about this area of the market. And again, private placements, which you will see over the next 6 months. Several go in there if you're a credit investor. You don't need to buy this newsletter if you're not. But a product that we sold for 3 to 5x more, that's one of the products that we're going to discount just for you. Which you should say, you should never discount a product. There's times that you do. Times like this that are crazy where I see opportunities where I know that we'll be able to charge full price for this newsletter. Everybody pay for it a year from now. That's an opportunity for you. Again, there's a newsletter I don't pitch often outside the last couple of weeks. That offer is going to be available to Curzio listeners only next week. So if you're interested, we'll send you an email. You guys, most of you are on our email list. It's pretty cool. But a lot of stuff. I'm going to break down more small caps, why I like them, and also share my favorite small cap idea with you in tomorrow's Wall Street Unplugged premium podcast. That's our premium podcast. Just $10 a month for that. That includes free subscription to our $1 Stock Club newsletter where we recommend a trading idea every single week based on the current news, what we're seeing, earnings, and stuff like that. So it's a lot of fun. If you're interested, want to learn more, just go to wsuoffer.com and that subscription. A free report. Remember I told you, include 20 stocks that are much better buy than Home Depot or growing their earnings and sales much faster than Home Depot, these large cap stocks, while trading at a cheaper valuation. 20 names. Get that for free, which is pretty cool. This guy's going to be focusing on small caps a lot over the next couple weeks. Pay attention. Lots of new ideas are going to be coming out. Portfolio's starting to ramp higher. We're seeing a bid in these stocks, and even when the market pulls back, and it will, a lot is priced in, just like we saw with Macy's. You can't get a worse report than Macy's. Missing earnings, lowering those estimates considerably, saying that less traffic, which is the death phrase for retailers. Less traffic, consumers closing their wallets. Okay, that stock was 13 when they said that 12, 13 days ago. And it's 16 today. That's what happens when your stock is down 50% and you're trading just 6 times forward earnings. Compared to a market that's trading 18, 19 times forward earnings. There's a big difference with those markets. I'll separate the good from the shit from you. And you're going to see a lot of that, a lot of new recommendations over the next couple of weeks. So questions, comments, I'm here for you. FrankCurzioResearch.com. That's it for me. I'll see you guys tomorrow. Take care.